Pack your bags, folks, because the market looks like it's in for a rude awakening very soon. And if you're interested or invested in any cryptos or Bitcoin, then you want to watch this video to prepare for what's coming. In this video, we'll be covering how the Fed decision to keep interest rates high is crushing capital markets and how we're now in dangerous territory. Then we'll pull up the broad market S&P 500 index. What do those yellow, white, and red vertical lines mean, and what can they tell us about the future? How this one often overlooked leading market indicator is screaming recession and looks eerily similar to the 2020 coronavirus crash, and how a wave of bankruptcies is going to lead to greater unemployment and affect company earnings and your crypto portfolio. In each of these scenarios, we are getting signals of a likely nasty market downturn. So by the end of this video, you'll have a better understanding of what's going on, whether or not now is a good time to invest, and clarity on how to approach your positions moving forward. Also, if you stick around until the end of this video, I'm going to share with you a bonus crypto that currently looks strong relative to the rest of the market. Hello and welcome to the Bull Runners YouTube channel. My name is Paul Light, and before we get into this video, I just want to share that this is not intended to be financial advice. If you're looking for that, go and consult with a registered financial advisor. This video is designed for educational and informational purposes only, and these are my opinions. But we're going to share some really interesting and unique things on this video that can help you be a little bit more forward thinking when it comes to your portfolio. So without further ado, let's get into the video. Now, the first thing I want to make mention of is this Federal Reserve interest rates. Now, interest rates are really freaking important because this is the entire, I would argue, global monetary system. We have a lot of money flowing throughout the world, but the majority of it is transacted or at some point in time touches the US dollar. And so the Federal Reserve and arguably Jerome Powell hold a boatload of power. Okay, now I'm going to specifically cover about 4 different periods where we had terminal interest rates. A terminal interest rate would mean the highest interest rate that we peaked out at and then stayed flat at. And the reason the Fed does this, just as a quick reminder for those of you guys who are new or maybe aren't, keen to this information, is to crunch or tighten capital markets. If they make a bank borrow at about 6.5%, or arguably 650 basis points is what it is, if you want to talk financially, then what happens is banks have to borrow at a higher rate, and then they even loan it out to you at an even higher rate. So borrowing becomes extremely expensive, and typically the weakest of the herd gets slaughtered, or better yet, people with poor credit don't typically get access to loans. So the goal is to slow economic activity, and as economic activity slows, okay, again, capital markets crunch and tighten. Companies can't afford to take on as much debt. People can't afford to spend as much, and so eventually companies start to lay people off, and in the process, as people get laid off, they don't spend as much, so companies don't make as much, and so it's just this constant downward spiral. And again, the Fed typically knows what they're doing here. When they increase interest rates for a sustained period of time, the economy starts to tighten and crunch, and their goal is to curb inflation and get it back down to 2%. We've been stuck in that 3% range for quite a while now, and since their goal is 2%, they're going to keep interest rates higher for longer, and they've only priced in about 1 interest rate cut through 2024, and markets know that. So that being said, that's not guaranteed, but one thing I want to make mention of here, okay, is that this current period of time that we've been at a high interest rate of 5.5 or 550 basis points or 5.5% has been 336 days for a period of basically 10 months. The previous time right here in 2018 through 2019, right before the coronavirus pandemic, right, in one of the gnarliest recessionary periods in history in terms of how fast the market dropped. We had a period of 6 bars for a terminal rate. Here, 14 bars back before 2008, the Great Recession, if you will, 426 days. And then finally, 7 bars back in the dot-com bubble. Now, you'll notice one thing that's really interesting here. consistently, you'll see that the Fed, in response to recessions, lowers rates to near zero. The first time around at about 100 basis points or 1%, and then down here at about 25 basis points, and they kept it flat for quite a while to stimulate economic activity. When it's cheap to borrow money, companies do it. People do it. People go and take that money, and then it gets thrown at the economy, if you will. They spend it in a million different ways. And obviously the people who have the assets and the companies typically make it all. So markets look really good. Capital markets love low interest rates. But every single time here, you'll notice, right, this was 2007, they started lowering, and then they lowered it to near zero in a fast, rapid pace in order to, again, keep up with an economy that was in crisis mode. They did it again here. They started lowering interest rates, and then it dropped off a cliff in 2020. And so now we are sitting at a terminal rate here for 336 days. Now, one thing that I really want to make mention of and note of is that we have 336 days here, 180 days here, 426, 214. If you take all of those combined, okay, and simply get the average, you'll notice, and I'm just going to go ahead and do that right now. If I can get that, you'll see, and I'll just hop right back on over here. You'll see that we had your average terminal interest rates right here would be about 274 days or 9 months. In other words, at about 9 months on average is when we start to do some rate cuts from the Federal Reserve. Now, I'm going to go ahead and hop on over to the S&P 500, okay? And we're going to start to track that against what happened in the actual greater market. The first thing I want to mention here right now is that these white lines, the yellow lines, and the red lines, okay, here's what they mean. The white lines mean the market top. That is when the market officially topped off before a recessionary period or a crisis. Okay, the yellow line would indicate the first Fed rate drop or cut, and then finally the red line would indicate at the point in time in which we saw a textbook recession. Now, before the Biden administration in 2022 basically changed the definition of recession, as we all know, they never claimed it. We had no economists coming out about it, even though we had 2 negative quarters of GDP growth. From the market perspective, a textbook recession would be a 20% or more drop in the greater markets, or a broad market index like the S&P 500. But specifically what I'm after is I want to see the time frame upon which we get a market top, and then how close that first rate cut is relative to the market top. Sometimes, and I'll give you that first example back here in the 2001 dot-com bubble crash, if you will, the market top happened in August of 2000. Okay, then over a period of 1, 2, 3, 4, 5 months, we actually had our first rate cut. So within a period of 5 months, the Fed said we've got to cut rates because maybe the economic data wasn't looking too hot. And they're like, if we keep them too high, we're going to absolutely crush everything. The problem is they're typically reactionary, which means they're not forward looking. They're always behind the curve, if you will. And so they respond by lowering interest rates. And guess what? By this point in time, literally a month later, we were in a textbook recession, and we remained in a textbook recession for quite a period of time. If you look right here, we were in a recession for a period of 56 months or 1,700 days. Why would I say that? Now, although the market was recovering during this time, we were actually 20% off those highs, and we had a total drop of 49%. Then the market recovered back to its previous all-time high from 2000 all the way up to 2007 to 2008. Okay, now here's what's really interesting. The Fed might have got some data again. They started increasing interest rates, right? And we're going to show you these charts side by side here shortly. But they started increasing interest rates. Within a month, the market topped. So now we have a period of 5 months within a range here. We have about a month apart here. And then about 1, 2, 3, 4, 5, 6, 7, 8 months later, we started to experience our recession, okay? And so the market top is really obviously what we're after. And there's no way in heck we could ever predict when the market top is in, but we're gonna use some data to try to, you know, get our bags in order. And then the market started to crash or collapse for a total of 57%. Now you'll notice something about these big red boxes that I've drawn here, okay, is that they are actually quite big and long. We had about 50% here, another 50% here. It took quite a while for this market to recover, slightly faster than this market. And this was arguably due to the first time our Federal Reserve ever practiced something called quantitative easing. It was a very nice term for them to basically say we can print dollars into oblivion to prop up the economy, save jobs, make sure the current administration looks great on paper, yada, 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 bail out the bankers, if you will. And in that process, right, markets recover a little bit more quickly. And you can see here that they kept that trend going through this period of time. Interest rates remained near zero. And guess how the market responded? It continued to climb over and over again. Now, we're going to see something right here. Okay, again, yellow line, rate cut. This was in July of 2019. Okay, our first rate cut, if you will. Then within a period of 1, 2, 3, 4, 5, 6, 7 months, market top. Okay, market top within a month, recession. Now, you'll notice that this red box right here, okay, was considered our recession zone. We dropped 34% on the S&P 500. We never reached our previous all-time highs right down here at 1,500. And that was due to, again, endless amounts of money printing. We're now $34 trillion in debt in the US. And look at how short-lived this recession would have been. If we didn't respond in such a way by printing trillions of dollars, the market wouldn't have recovered in the way it did. It would have probably looked more like this or even worse, okay, because this was one of the most out of the blue type crazy black swan events you could ever imagine. But you'll notice something that's really interesting here. We had a month difference here. We had about a 6-month difference here. We had about a 7-month difference there. Actually, I think this was 5. And in most scenarios, all of these lines are pretty close together. Well, guess what's starting to happen? And by the way, we had a 25% drop here in 2022, even though we didn't have recession. This was considered our recession zone, but we actually started to raise interest rates later on to here. I'm just trying to use past or history on interest rates and market tops and then recessions in order to predict what could potentially happen here. So what we're going to do now is pull these charts up side by side, and you'll notice right here. So I'll go ahead and get this sidebar out of the way, and so we can look at it properly. Now we're going to align both of these charts up right here for you, and you'll see, okay, wherever my crosshair is, that's pretty much aligned with both of the charts. So right here, we had the market top within the time frame of the terminal rate. Then the very first time they lowered interest rates, the first month right here from this terminal rate peak down, okay, we started seeing a recession. And guess what? They continue to lower interest rates into the recession as a response. In other words, 9 times out of 10, the Federal Reserve Bank is behind the ball. So whenever you start to see that first rate cut, it typically means run, okay? Now, I'm not saying that it can't happen sooner. I'm not saying that this time around can't look different. I'm saying more often than not, whenever you start to see that first rate cut, you're very close to a market top. Here was within a few months, and then here yet again, you'll notice, watch, terminal rate, and look at this, first rate cut, then the month later, top. Wow. Interesting, right? Then recession, and again, in response. Then, in order to stimulate the economy, they kept interest rates really low, and look at what happened. And then finally, right over here, again, look, first interest rate cut. And you know what's funny? Even if you're like, well, I want to catch the exact top, the amount of gains you would have had over the period of, I don't know, a decade, 8 years. I mean, you're not going to get much more trying to wait for that top at 10% extra gains here. It's really not that big of a deal. And yes, the market top came in shortly thereafter, okay, in February when they cut rates in the summer. So maybe you can wait through the end of the year, but then we had a gnarly crash. And so we we've been really high for quite a while now, but I thoroughly would expect that they are going to start to cut rates in response to a negative environment for the general markets. So as markets continue to climb here, eventually the top might be in after or before, but within a very close range in terms of months of that first rate cut. Now let's move on to the next point. So I'm going to pull up the Dow Jones Transportation Index. Okay, now this is again an average on the deal, but what the goal of this thing is to track transportation, which is considered a leading economic indicator. Okay, the performance of the transportation companies can provide insights into basically the broader economy's health. So if the index is rising, it suggests increased demand for services and implies that higher industrial production and consumer spending is there. So as you'll see right here, I'm on a weekly time frame, but we topped off here in 2021. And so although that the economy has looked like it's got better, although these indexes have grown consistently and put in higher highs, the index here says that demand hasn't really increased and is now actually putting in a new lower high here from January till present day and is actually declining. Now, what I'm specifically after is actually the Dow Jones Transportation Index versus the S&P 500. And what you're going to notice here is something really freaking scary. Okay, this was a chart that I'd actually pulled up earlier. And one thing that I'll make a note of here is back in 2020, okay, we saw this, index, if you will, decline all the way down here to 2.72. And again, this was in May. In other words, demand virtually stopped, okay, while the S&P 500 continued to stay in a range, demand was virtually done. And so all we're seeing right now is a complete collapse in the transportation index versus the S&P 500. Okay, so I'm going to toss this line right on here, and you can see we are right in that range. And the last time that we were was back in 2000. So things are starting to get a little bit scary, or 2004, I should say, when we were actually starting our economic recovery, and we've officially topped off. We are now putting in a new low, and arguably this thing could go lower as the S&P 500 continues to climb into new highs, which I would consider a divergence. Okay, so the S&P 500 continues to climb up while the transportation index stays flat or starts to decline, which is actually very scary because it means demand isn't there. It's something that you would consider a bellwether. Okay, it's going to point in the direction of what's actually going on. Next up, the US economy is headed into a corporate bankruptcy cycle that will spike unemployment. Okay, now if we come into this article, I had already made a mention that a wave of large bankruptcies is about to hit the US economy that could spark job losses for a growing number of Americans. Well, this guy from the QI Research, which is probably just a company that tracks this stuff, okay, made a note of the fact that we saw an increase in corporate bankruptcies of 88% through this year, which actually marks a 12-month high. 9 companies worth 50 million or more have failed so far this year, and this is the fastest pace of large bankruptcy filings since the pandemic. Right here, David Lin says, I think that the bankruptcy cycle kicking into high gear is going to be enough to tame inflation. Now, the reason that inflation has remained unreasonably high is because the market hasn't felt the pain enough yet. And so companies are going to continue to keep their prices high. And why would they have a reason to lower them if people continue to spend prices for that? But if demand continues to decline, eventually companies are going to have to lower their prices to meet demand, which should ultimately tame inflation. And by that point, the Fed would be happy to lower interest rates. But typically that's not what happens. They lower interest rates in response to these types of situations. So in order to tame inflation, they need to keep interest rates relatively high, if that makes sense. The US job market remains on solid footing, but the unemployment rate has ticked up to 4%, which will bring me to the chart. Okay, now, one thing I want to make a mention of here is that back in 2020, right, which was, again, a black swan event, if you will, we had our lowest ever unemployment rates. Now, typically, when we're in these ranges right here at about 3%, that's pretty low, and arguably that's a healthy market rate and economy. Then what happened was the market crashed, right, in response to COVID. Everyone shut down, so everyone got laid off, and then they filed unemployment. And so right here, you have all of these people that are collecting unemployment. We had almost 15% of the nation in a single month, okay, collecting unemployment, which was absolutely crazy. Then the market started to get better. Things started getting slightly healthier, right? And then we started bottoming out here, and we've been in a bottom basically since 2022. Okay, as you can see here, we've been in this range of like 3.4% up to about 3.7%, and then we started ticking up. Now, one thing I want to make a mention of here is this is not a great thing to do technical analysis on, but I'll increase the size of this chart here for a second. Whenever we start to tick up, as you can see right here, and break above a strong range, in previous cycles of unemployment due to a recessionary environment such as this, things continue to climb to an unhealthy and an unreasonable unemployment rate. In the case of the Great Recession, we saw about 10% of working age Americans collecting unemployment. Again, a sign that the market ain't doing too hot and people need to get back on their feet. But what I'm really after is looking for this line here. And as you can see here, we had a bottom right here in a range where then we started kicking it into gear and putting in new higher highs and higher lows. Higher high, higher low. Higher high, stayed in the range, continued climbing up month after month after month. Okay, what I'm really after is this little range right here. You can see the same dang thing happened in 2000 to 2001 in the dot-com bubble. We had a low right here. We started putting in higher highs, higher lows, and continued to climb to a peak. Now, it's kind of interesting when you really look at what's going on with the economy. It comes in ebbs and flows in terms of unemployment, but generally speaking, we're starting to see more consistency in terms of how great unemployment becomes and how volatile things become, right? At first, it was like little waves, and now it's getting bigger and bigger. So I don't expect this next time around to look as big as this, or maybe even as big as this, but I'm starting to see it tick up, and that's really what I'm after. And then when you track it against the S&P 500, you'll start to notice something. Okay, so we'll come right back here into the 2001, 2008. Okay, right over here, when we started ticking up and putting in higher highs, higher lows, we were already into the throes of the recession. And so as we started to really increase our trajectory on unemployment, right, we were already deep into the recession. When we actually peaked off in terms of that unemployment rate right here in 2003, you could see the recovery was well underway. Okay, same thing here in 2006, 2007, 2008. When we started peaking off, you'll notice right here, we have this range here, and I'll put a line right there. Okay, right here we had a top on the market, then the unemployment rate started climbing, and then it became monumental in terms of how fast that thing was moving, and then when we peaked here, we were already deep into the recession, past the recession, and into the recovery at the peak. In other words, unemployment acts as a lagging indicator, if you will. Whenever we see the peak on unemployment, typically the recession has already happened and a market recovery is on the way. However, right here, and I'll just put this line here, whenever I start to see a new trend start in terms of unemployment, and it doesn't mean that we're in a recession yet, but it means by the time maybe we start to peak, right here. Let's just say this thing continues climbing and then puts in something like 10%, 9%, 11%. I don't know. Okay. Whenever we see this peak right here, it typically would mean that we're into a recovery in a range right here. So it's really important that you understand that this would be a lagging indicator, but it is an indicator nonetheless that whenever we start to see a new directional change in the trend on unemployment, that the market really is giving us a signal that things aren't looking so hot, even though we're putting in higher highs. From the Dow Jones theory perspective, okay, the Dow is actually trading negatively correlated to the S&P 500, which simply means that the Dow Jones has now put in a new lower high, and I'll even go ahead and pull it up on this chart right here, put in a new lower high, while the S&P 500 has put in a higher high. So they are starting to diverge. They're going in opposite directions, and I'll go ahead and pull that up right now. And I will put it on a percentage scale. And so you can see here that we had the markets looking relatively similar in terms of how they trade. We put in higher highs right here and here, markets dumped together right here, new high right here. And guess what? Here's what's interesting, right? The S&P 500 is just pushing into these new highs here and is up about 14% over here, while the Dow Jones in the same time frame is actually putting in a lower high and really struggling. So as they're diverging, it is another market indicator that things ain't looking too healthy. It seems to me that Bitcoin, okay, and the dollar and the Dow Jones are trading in alignment. The one thing that is out of alignment is the greed of people trading the S&P 500. So I'm starting to get all of these really weird and mixed signals, which leads me to believe that we recently reached the top on Bitcoin. So let's hop on over to the chart on Bitcoin, and we'll talk about your cryptos and potentially what could happen and how I'm going to think about these things into the future. So here we have a chart of Bitcoin, and back in January of this year, right, we had the announcement that we would have the Bitcoin ETF. And since that point in time, the markets really rallied on that news. Now, typically in most news event type scenarios, if you will, right, you want to buy the rumor and then sell the news. Well, that news event, if you will, lasted all the way through March. And then again, you know, the entire greater market was looking pretty hot through that range too. So it wasn't like Bitcoin was on its own there. We could track it against other things, but we're not going to go ahead and do that. What we saw right here was a top at $73,000. Then we saw the market fail to rally beyond that at about, and I'll just toss a line on there because that's how simple things can be sometimes. I'm telling you, people complicate things with fancy indicators and all of these interesting tools, when in all reality, you just need to get a pulse on the market, and then you need to decide based on price action, horizontal supports and resistances, what's really happening. Okay, volume would always confirm or deny that theory. Now, we had a sell-off consistently at about the 71,600 ish level to, yeah, about that range here. Now you'll see that we wicked and touched here, and then we went and wicked above and then broke down again, and then we put in what I would consider an inverted head and shoulders, okay, because you can connect them at the neckline right there. We had a shoulder right here, we had a head right here, we had another shoulder. This would be the neckline. Yes, you can do head and shoulders that are not perfectly horizontal, okay, so this would be a trend line tool. Now, when we broke out, we made about, I would argue, close to 100% move, and then failed to break out a fourth time and a fifth time. Now, what I was looking for was some level of support here, and in particular, above the range right here. I would argue between 65,000, okay, and 67,000. This is a really important range to hold. And as you can see here, when I pull up the VRVP, which is a visible range volume profile for this entire range, the volume was really strong and stacked here at 67,000, which means it's a point of interest. And the fact that not only did we break out, but then failed to stay above or break above this range here at 73,000 and put in a new high, has now confirmed to me alongside all of this other greater market weakness and a weird divergence with the S&P 500 that we are now breaking down. What's more important too is when I look at, and I'll just go ahead and get rid of that guy, I'll get rid of this guy, I'll get rid of this guy, is this range right here in particular, okay? And we're talking over a period of, well, let's find out, 30 days now, where not only did we fail to break out, but we failed to hold support here. So typically, right, what used to be a resistance here and here became a support here, here, and here 3 separate times. And you know, supports and resistances are like doors. Typically, the more you knock, the more likely you are after knocking over a period of time to have the door be opened. So supports and resistances, the more times you knock, the more likely that you're going to break out or break down. Okay. And the fact that we failed to break out after 5 times mean it was more prone to breaking down. And so I'm assuming I could look at the RSI and other things, and maybe we'll do that in a different video. But what I'm really after is a simple support and resistance range here. Again, resistance here, supports here. Well, guess what? When we broke down, we failed to stay above. And arguably, I think the biggest and most important candle was on the FOMC interest rates meeting, okay, if you will. They were going to decide interest rates and then also announce the core CPI. The market really rallied behind that up to 70,000, only to be sold off on a massive wick. This looks like a big ol' exit from people who know what's happening in the greater market and used this liquidity in this event to get out of the market. And then you had this bearish engulfing candle. On the next day, we had another bearish candle, which tried to break back above and into the range at 67,000, only to be sold off. And now we're getting another 1, 2, 3 days later, on Monday, June 27th, or sorry, June 2024. Okay. We saw another sell-off and arguably just a retouch of that resistance. So it's confirmed to me that this is a straight up resistance, and we're getting new lows here today. We ranged into a low of $64,000. So yes, the bulls are trying to buy into this range here, but arguably the bears are stronger, and the market is proving that, which means that our next range of support would really be somewhere down here into the 62,000. Okay, and we can pull that VRVP up again, but I like using a box here up to, you know, $60,000. That would be my next range of support and resistance. But typically when markets climb, right, it's like taking a staircase up, and when markets collapse, it's like taking an elevator. Just because this can be a support doesn't mean it has to be. Sometimes markets just bust right through it on some crazy event or news, okay? And anything can happen, so you've got to prepare for that. So if you're in the markets, again, this is not financial advice, it's just an urgent warning to practice caution here. In other words, keep your tight stops, okay? Don't just throw things out the window and say, I'm gonna hold on because I like the token. It doesn't matter what cryptos you're invested in. If you're in Bitcoin, or if you're in any crypto or altcoin, if Bitcoin is not performing, I can assure you your crypto is probably not going to perform either. So, you know, if I just pull up right here the Bitcoin dominance, you can see that Bitcoin dominance is climbing. Why? Well, and we've talked about this. I've already shared this in a previous video update where Bitcoin dominance is trending up, and it's because people would rather hold Bitcoin than their altcoins. Altcoins are down far more than Bitcoin. If Bitcoin is down, and I'm showing you right here, 1.4%, then sometimes your favorite cryptos will be down 6%, 14%, 9%, right? People are just selling off. I mean, you look at something like this, Bitcoin is down. This thing is tremendously down, and down below a major support, a yearly support right here. So it's not just, you know, Bitcoin, it's everything else, and everything else is far worse off in an environment like this. I mean, you look at FTM, right? We just broke down below. You could look at Casper below a major support range here. That was a yearly range. And so there's a lot of tokens, there's a lot of great companies and projects out there, but ultimately what this is signaling to me is that people don't want to hold any of these tokens into a massive, you know, sell-off or a liquidity event, right? So it's a really scary time to be in the markets, and I just want to urge you to be cautious, careful, keep your stops tight. So we'll hop on over to CoinMarketCap and we are going to type in Jasmy coin. Okay, now what's really crazy about this thing is it's currently sitting at a market cap of $1.6 billion, and on the month we're sitting at well, we're up quite a bit, okay, to a 0.033 price. When we started out that 3-month period, we were at a 0.02, so it's been quite an interesting climb. Now, that being said, what caused this token to increase in value so much? Well, apparently, there was an NVIDIA partnership, Sparks Jasmy coin surge. In other words, there was a rumored partnership. Okay, Jasmy is a Tokyo-based Internet of Things company, and there were rumors of a potential collaboration with NVIDIA, a top global company, have significantly contributed to Jasmy coin's recent rise. Following Jasmy's announcement about developing artificial intelligence infrastructure in Japan, speculation concerning a partnership with NVIDIA has stirred excitement. Now, when we look at the token itself and what they're aiming to do, they are doing some infrastructure type plays, okay? They're decentralized data, which is, you know, it requires infrastructure. When you think about companies like Amazon, they require a lot of computers and databases to properly operate and make sure your packages get to you on time. The same thing is true of virtually every major technology company. Well, a lot of these technology companies hold on to your data and then utilize it however the heck they want. Remember Facebook. And so in this case, what they're saying is that they're democratizing data to the point where you safely own your own data and that companies can go ahead and build on their infrastructure. So we're not going to go through everything here because ultimately I wouldn't really care about this if the token wasn't performing relatively well to the market. But what I also found really interesting was that they have some really big players involved in their management. Okay, they have a representative director named Kunitake Ando, which is a former president and COO of Sony. Okay, everyone knows what Sony is. Currently, the president and chief operating officer is a guy by the name of Kazumasa Sato, is the former CEO of Sony, Style.com Japan. Now, the reality is this could all be a complete and total scam. You know, sometimes company websites don't have to look absolutely brilliant and amazing if they have the right infrastructure in place. If you take into consideration someone like Warren Buffett with his company Berkshire Hathaway, they have a website that looks like it was built in 1995, right? But that doesn't freaking matter because they're actually doing things in the real world. And his companies do. And so this could be completely crap. It could be amazing. I'm not 100% sure. This is something that I definitely wanted to turn you guys on to because of, most importantly, the price. For me, this is an interesting range. While most tokens are down, okay, relative to the market, like Bitcoin is down a couple percent, you know, your favorite altcoin might be down 10%. Well, this one seems to be up relative to the market. Back here in 2021, we obviously experienced our all-time high of at about $5, and then it proceeded to sell off. We saw our low at about 2 cents back in January of this year. And it ranged for quite a while, right? We had a lot of support and arguably virtually no selling. Everyone had already capitulated. The price was kind of boring. If I pull up volume, you'll see here, it didn't require a ton, but it required a couple $1,000,000, right, at a time in order to really allow that price to break out. When we broke above the 0.007 range, the thing really started to rally. And so we're putting in higher highs, higher lows. The trend looks healthy and strong. We blew right through that previous range resistance, if you will. And so now we've developed a support right here at about 1.5 cents. And I would argue about 2.6 cents. So I'm not saying go ahead and buy this now, but the volume looks really good. If this NVIDIA partnership thing is true and people start to catch on to it, the market's really gonna bite into that, even if we don't have that much time left in a rally or, you know, in the market before a bear. Ultimately, this looks like something that I'd want to buy on some sort of a support range right here at the 2.6 cent range, and definitely down down into the 1.5 range. I'm not saying anyone should buy it, but it's definitely a point of interest for me and something that I'll be paying close attention to. So thanks so much for watching this video. I hope you learned something. And if you enjoyed the video, go ahead and click the subscribe button, smash the like button, and I look forward to seeing you in the next video.